Green across the screen for equities. 30 minutes until the start of trading in New York. I'm Scarlett Fu in for Matt Miller and Danny Berger. Bloomberg Open Interest starts right now. Coming up, another circular deal. Amazon said to be in talks to invest more than $10 billion in OpenAI. Meanwhile, Warner Brothers is urging investors to reject Paramount's hostile takeover bid and back its original deal with Netflix. And the year's biggest IPO, Medline, makes its trading debut today after raising more than $6 billion. Now, stocks to watch in this early going here. Netflix moving as Warner Brothers advises shareholders to reject Paramount's hostile takeover bid due to concerns about financing and other terms. You see the stock currently up about 1.6% for Netflix. OpenAI is in initial talks to raise at least $10 billion from Amazon and use its chips. This is a potential win for Amazon's effort to broaden its AI industry presence. And Oracle dropping in the pre-market here on a report that Blue Owl will not back a $10 billion deal for their software giant's next data center. So let's begin with those AI deals with Bloomberg Tech co-host Caroline Hyde. Caroline, put this into context for us, because clearly the report about Blue Owl not supporting Oracle's next data center was a surprise to investors.
We are actually getting breaking news from an Oracle spokesperson as we speak, saying that at the moment, the equity deal on the Michigan data center, the one that we're currently talking about, is still on schedule. There had been reports in the FT that there have been some delays, there have been issues with zoning, with getting the right regulatory approvals, and it's meant to be coming on schedule, or at least start work in 2026. So they say that the Michigan Center is still on schedule. Oracle is also saying Related Digital, which is actually the company that's building out the data centers. It's their partner of choice that does the digging, that does the putting together. Oracle just leases, and of course it gets the financing from Blue Owl. Oracle is saying Related Digital, it chose the best equity partner on the deal. They're also commenting on the Michigan data center by email as we speak. Now, this is all in response to the FT reporting that is saying that Blue Owl, which basically pioneered the way in which they help finance data center build out and then you lease it to a hyperscaler like an Oracle, like a Meta, like an Amazon, that Blue Owl didn't want to do this 10 billion 1 gigawatt version in Michigan. It was within the reporting that there's some anxiety around Oracle. The amount of debt that it's putting on, Morgan Stanley thinks it could go almost to in excess of 300 billion by 2028. At the moment, it's in excess of 100 billion. And there was worries that would Oracle be good for paying these sorts of leases in the longer term. There's also issues that basically the people that are going to lend to Blue Owl, because Blue Owl goes out there and says, yeah, I'll help you finance it, but I'm going to get other partners. I'll put equity into mine, then I'll get other partners and lenders. Exactly. That lenders are looking at this saying, I want more strict terms. I want to understand exactly the risk going into this data center. The issue was Blue Owl had actually said, this deal isn't good enough for us. We're not going to do it. But more broadly in the FT reporting is saying actually then other lookers on were thinking of coming in and stepping in to fill the void, but we yet don't know whether there is an equity partner of choice, and that's still in due diligence as we speak.
So you mentioned anxiety about Oracle. Is it about Oracle specifically, or is it about the whole AI build-out?
The way that this reporting is going and the way that the market has been focused on Oracle is, yes, it's more specific to Oracle. People are being discerning. Look, they sold off Meta during its earnings season because they were taking on more and more capital expenditure without perhaps the revenue many felt to prove it out at this time. But they didn't sell off Alphabet. They're not worried about certain hyperscalers that are good for the money, that do have an awful lot of cash on hand, whereas Oracle has been deemed a little bit more risky because the $100 billion of debt, because it's turning to cash flow negative. And then there was the fly in the ointment that we got on the 10Q after its earnings, showing that they had almost $300 billion worth of data center leases going out into the future. And people are just trying to digest that this is enormous.
Yeah, absolutely.
And how is this business model going to hold?
Okay, so we talk about that. We also talked about OpenAI in talks to raise at least $10 billion from Amazon and buy some of its chips. I didn't realize that Amazon made chips.
Yes, Trainium. In fact, AWS, Amazon have been doing this for a very long time, and they've been using their own chips for a significant amount of their own work, but it's also been why they work with Anthropic so closely. They had an enormous deal with Anthropic to bring on and help them develop and train their own models using Amazon's own chips. This is another story of vertical integration. Alphabet's doing it. Amazon has been in many ways pioneering it, but maybe had lost a little bit of the limelight of the prowess of its chips to the likes of Alphabet and certainly to NVIDIA. But here is another case that OpenAI is wanting to get cloud and compute from wherever it can. But can it afford it with the current revenue run rate of about 20 billion for this year, as we understand? Probably not. So they're getting creative. Once again, they're turning to Amazon for equity to be able to pay Amazon in the future for its cloud deals. And of course, it helps Amazon to say, look, we got yet another key LLM designer and maker here using our chips. Maybe it's a competitor to NVIDIA longer term for the inference part.
So for those who are worried about circular financing, they can add this one to their list as well.
It's still coming.
All right, Caroline Hyde of Bloomberg Tech. And of course, be sure to check out Caroline in the 11 a.m. hour. In just a few minutes as well, we will be joined by Wedbush's Dan Ives on his latest note about AI in 2026. Now, in other deal news, Warner Brothers is urging investors to reject Paramount's hostile takeover bid in favor of its original deal with Netflix. Warner Brothers deemed the Paramount offer inferior and inadequate. Joining us now is Geetha Ranganathan of Bloomberg Intelligence. I guess this is not a huge surprise given that Warner Brothers made clear that it backed Netflix's deal from the beginning, yet they have itemized some of their specific concerns. Geetha, how justified are these concerns?
I think it's pretty justified, Scarlett. So they obviously, there's constant referencing to very shaky financing terms. They talk about the Ellison family kind of misleading investors, saying that the deal is completely backed by the family when in fact it goes back to a revocable trust. And the problem there is that those assets can be pulled out at any time. They talk about the language in the agreement having a lot of different loopholes with, Paramount, reserving the right to amend its conditions anytime. Basically, leaving Warner Brothers shareholders to kind of hold the bag, suggesting that much. So lots of risks all over painted by the Warner Brothers Discovery Board, apart from the fact that, of course, the deal itself is somewhat inadequate because it undervalues the TV networks and it's inferior to Netflix.
Now, one potential risk seems to have disappeared because Jared Kushner's private equity firm, Affinity Partners, has pulled out of the bid completely. I think it was supposed to play, a somewhat relatively minor role, providing about $200 million to the financing. Does that change the scope of the offer here from Paramount Skydance?
I think a little bit. Just the optics of it was really bad, considering his affiliation with, President Donald Trump. But again, I don't think it necessarily changes the calculus all that much, Scarlett. It was interesting that, Warner Brothers Discovery basically saying that they don't really see much of a difference in terms of the regulatory risk for either the Netflix or the Paramount deal, thinking that, they both can ultimately pass muster with regulators. But again, that's all up in the air. We really don't know how that's going to play out. Right now, what they're really, really stressing is that the financing seems very, very shaky.
All right, good stuff. We will continue to monitor this. Geetha Ranganathan of Bloomberg Intelligence. Now, our other top story is the biggest IPO of the year. It's Medline, raising more than $6 billion, pricing the shares near the top end of the marketed range. It gives the medical supply manufacturer and distributor a market value of about $39 billion. Joining us now is Bloomberg's Bailey Lipschultz, who covers IPOs. And Bailey, this was an upsized IPO as well.
Yeah, this was an upsized deal that really kind of surprised some people on the buy side in terms of the fact that they did pretty much maximize the amount of shares that they could sell without having to refile. So, as you mentioned, biggest deal globally this year, biggest U.S. IPO since Rivian back in 2021. So a big deal for a number of reasons, and a big deal getting out of the door in the twilight of 2025, and at least for now, delivering a big win to these private equity firms. It'll be interesting to see how today unfolds and how the remainder of the year unfolds for the company.
Yeah, to that end, biggest private equity-backed IPO as well. In this initial public offering, there are a bunch of cornerstone investors who lined up for a sizable part of the commitments.
Yeah, they stepped up for at least the initial launch, about half of the book. So what that can really signal to investors is, A, there are a number of investors who are kind of a who's who agree in this company's prospects, and also we're basically saying that wherever bankers decided to sell the deal, it would make sense. Not a surprise. We've seen this play out a number of times. But again, when you have a deal that ends up selling more than $6 billion worth of stock, you need people to show up in size. And it certainly doesn't hurt when you have kind of a laundry list of investors who, again, are willing to put their name on the line and are willing to go on the cover. Again, we should get some of the book color in the coming hour or so around how this deal ultimately was allocated. But that kind of is a step that you normally will see when we are in a market that maybe is has less conviction, or, to be blunt, has less than 2 trading weeks left in the year.
Yeah, absolutely. All right, MDLN going public today, and of course, we will bring you the numbers when they begin trading. Bloomberg's Bailey Lipschultz covering IPOs for us. In terms of where things stand in the broader market, you are looking at gains here for futures, although we did give back a little bit of the advance following that report that Oracle, cannot line up financing from Blue Owl, at least for the next data center. Plus, Brent crude and gold, you could see they're positive today. A lot of concern about geopolitical risks. The U.S. is preparing new measures against Russia if Moscow rejects a Ukraine peace deal. And President Trump ordering a blockade of sanctioned tankers going into and out of Venezuela. Gold approaching that record high level of 43.81. Now, coming up on Open Interest, Wedbush's Dan Ives sees AI spending in the $600 billion range next year, including plenty of spending from governments and non-tech players. He joins us to discuss his 2026 outlook next. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. Tesla hitting a record intraday high yesterday on optimism around its self-driving and robotics push. But the company's EV business, its main business, still faces challenges. California's DMV warned that it could suspend Tesla's sales for 30 days unless the EV maker stops marketing its full self-driving in ways that the agency says overstates its capabilities. Tesla can avoid the halt if it changes how the technology is described. Waymo in talks to raise more than $15 billion, pushing its valuation close to $100 billion. The Alphabet-owned robotaxi leader is expanding quickly, now generating more than $350 million in revenue. Waymo says the new funding would help widen its fully driverless ride-hailing services across more cities in the U.S. American consumers are spending less on video game consoles, such as Nintendo's Switch 2 and Sony's PlayStation 5. Sales fell 27% last month. That is the worst November in 2 decades. Tariffs and rising component costs have pushed prices to record highs. And OpenAI in early talks to raise at least $10 billion from Amazon. This is a deal that could push OpenAI's valuation north of $500 billion and shift some of its AI training to Amazon's Trainium chips. The move would boost Amazon's young chip business and strengthen AWS as it battles rivals for AI dominance. Talks are preliminary and could change. Now, sticking with the AI trade, in a new note out today, Wedbush analyst Dan Ives says, quote, "The AI winners should be bought, given our view that this is year 3 of what will be a 10-year cycle of this AI revolution build-out, with 2026 set to be an inflection point year for AI monetization." Joining me now at the desk is Dan Ives. So year 3 will be when we really see the rubber hit the road. Who's likely to be the winners here? Because it feels like the market's already designated Oracle as a loser.
Yeah, and I disagree that Oracle is a loser, just given my view. When you look at the AI revolution, I mean, for the first time in 30 years, U.S. is ahead of China when it comes to tech. And I think what you're seeing here play out is like, yeah, there's some white knuckles, but the reality is you have 3 to 4 trillion that's going to be spent in the next few years. Oracle is going to play a huge role in that. And I think right now, in the penalty box, I think we sit here a year from now, and it was a huge buying opportunity. Just like the view, if you go back a year ago, New York City cab drivers bearish on Google. AI is going to destroy the model. It's going to get broken up.
In a completely different area now.
Now, look, today, I mean, everyone's super bullish. So I'm just saying, this is a bull market, 2 more years left. And I get it, we're going to have some of these moments, but I don't think in any way that this is sort of the moment where you head for the elevators. It seems that you buy some of these names, in my opinion.
But Oracle's balance sheet looks very different from the other hyperscalers, right? It's not an Alphabet, it's not a Meta, it's not an Amazon when it comes to its cash levels and its cash flow. So there is reason to be at least a little bit more dubious or suspicious of Oracle's finances.
No doubt, but look, when OpenAI calls, you pick up that phone. And I mean, if you look at what that growth's going to look like, I mean, the next few years, you're not seeing the next quarter or two, but in terms of their RPO, we're talking 400 or 500 billion. And obviously, OpenAI, 300 billion of that. But to me, it's just one of those where we're going through one of these periods where it's a glass half empty. And I get it. And I think it's healthy for the overall tech trade. But I think when we look out, I mean, I think tech stocks are going to continue to rip into next year because we're still early days in this AI build out. You only have 3% of U.S. companies that are going down the AI path, and I see it on.
It's highly concentrated.
Well, it's concentrated, but now it's spreading. I mean, I see it like authentication. What we see with Orbs in terms of authentication on that side of the area. You look at cybersecurity, CrowdStrike. You see Palo Alto. You look at other names that are playing it out. I think it spreads to second, third, fourth derivatives that we're going to see play out across tech.
Okay, before I let go of this Oracle story that the FT reported Blue Owl will not back the $10 billion deal for Oracle's next data center, how are you thinking about this reporting? What does it signal to you?
Look, I think there's a better chance of me playing in the NFL this weekend than this data center ultimately not getting built out. Now, I'm not saying terms, partners, it goes through some negotiations. But my view is like in moments like this, just like DeepSeek moments, just like Liberation Day, just like U.S.-China worries, I get that the bears are going to sort of own the day, especially when it comes to a name like Oracle. But it's not time you panic. I think Oracle actually here is a compelling name to own, given the risk reward.
All right, let's talk a little bit about the Amazon discussions with OpenAI about letting OpenAI use its Trainium chips, also investing at least $10 billion in OpenAI. Talk about Amazon's role in the whole AI build-out.
Sure. I mean, look, Jassy is an AWS guy. So if you think about where we are in terms of this arms race, Dell and Microsoft clearly at the top. You look at everything that Google has done in terms of Curry and how they've successfully built, especially on the cloud side, and really, that's been a huge turnaround. But for Amazon, this is a huge opportunity for them on the data center side, given their cloud customers in AWS to go after. I mean, they got to jump in the deep end of the pool. You do with OpenAI. So I think to some extent, even though right now, if you look at the diversion that we're seeing with stocks, tied to OpenAI that are negative, Amazon, they want to be more associated with them because that is really going to be the build out when we talk about this AI revolution and you're still in the third inning. Amazon wants to ultimately, really build this out with a partner like OpenAI and not be on the other side.
I get that, but will the Trainium chips actually be a real competitor to NVIDIA's chips?
See, my view is today, there's only one godfather of AI. He's wearing a black leather jacket. His name's Jensen. So at this point, 12-to-1 is demand to supply for NVIDIA chips. But the reason AMD, the reason you're going to see other players in, you see Google in terms of what they've done on, from a chip perspective, they'll play in that game. That's a long-term bet. It's no different when Apple bet on chips in terms of they're going to ultimately seed out Intel. It took 5, 6, 7 years. But these are long-term plays in this arms race that's playing out. But we're in year 3 of an 8 to 10 year AI revolution.
Year 3 in an 8 to 10 year revolution, there's going to be bumps along the way. What do you see as the biggest risk to your bullishness, to this positive story?
Energy. I don't worry about things like the Oracle data center build out. I don't worry about capital I don't worry about the use cases. To me, as someone like that's seen it, firsthand, traveling around the world, this is a true fourth industrial revolution. This is not a bubble, this is an AI revolution. The biggest issue in the US is energy. 3% of U.S. companies has gone down the AI path. When you get to 20%, kind of clock strikes midnight. So that continues to really be the issue, in my opinion. That's why I think nuclear continues to be the answer. And I think that's something right now, from a U.S. perspective, we're ahead on tech. But relative to China, China's ahead when it comes to energy.
So does the concern about the limitations, the restraints on energy show up in 2026? And if so, how does it show up?
I think I think this is a huge inflection point. You guys see government in terms of administration get fully behind it. You're going to need to see a lot of innovation from a nuclear perspective. Look, solar, grid, things like that, I mean, that's maybe stopgaps, and that could help a little. But in terms of, there's more data centers under construction today than active data centers. Nuclear is going to be the answer, and it comes down to how do you actually get at what are the private companies out there, what's the innovation. To me, that's the biggest thing that could be the aha moment. Energy is the biggest constraint in the U.S.
Energy is the biggest constraint. So within the AI tech world, the tech name specifically, is there any one that you think maybe has gone past where it should, at least for now? In the near term, you can kind of back off a bit.
I mean, look, there's some
Tesla near record high?
Look, Tesla I've talked to. I mean, it's going to be a golden year for Tesla. And I think $2 trillion, ultimately $3 trillion bull case because, in my view, you talk about everything in AI, autonomous, robotics, it's just starting. Now, Musk, wartime CEO, and I think you're seeing investors understand what the future is going to look like from Elon and Tesla. Look, are there ones that could get over their skis from a stock perspective? Yeah, but right now, it's my view that like investors are underestimating the scale and scope of this AI revolution. And like me and you have talked about, AI party started at 9 p.m. It's now 10:30 p.m. Party goes to 4 a.m.
All right, 10:30 p.m. until the party ends at 4 a.m. Wedbush's Dan Ives, always a pleasure. Thank you so much for joining us on set. A lot more to come here on Bloomberg Open Interest. In the next hour, we've got more on the AI trade with Ann Berry of Threadneedle Ventures. This is Bloomberg Open Interest. Good morning. A check on futures ahead of the opening bell here in New York. We're looking at futures higher, pointing to a positive open for the S&P 500, potentially a rebound from a three-day decline. The S&P yesterday testing its 50-day moving average, its short-term trend line, but did manage to stay above it. All right, let's take a look at some of the other movers on our radar. Homebuilder Lennar's forecast for quarterly home orders missed estimates as affordability and the weakening job market puts buyers on the sidelines. General Mills, its sales topped expectations as it improved packaging costs and lowered some prices. And we get Micron earnings after the bell. This is the memory chip maker who has nearly tripled in value this year as it capitalizes on price increases for its products. And Robinhood unveiling a suite of new betting features, including parlays for football games. It says more than 1 million users have traded roughly 11 billion contracts so far. The CEO, Vlad Tenev, will be joining Bloomberg Markets today at 12 noon with Tim Stanovic and myself. All right, less than 4 minutes ago before the opening bell, our next guest is Seema Shah. She says the same growth drivers that proved resilient in 2025 will continue to reshape the macro landscape in 2026. She joins us next. This is Bloomberg Open Interest. Moments away from the start of trading, and this is Bloomberg Open Interest. I'm Scarlett Fu, stepping in for Matt Miller and Danny Berger. All right, we have futures rising right now. They did close higher before the market begins opening, and what we know is that they are up, and this could be the end to a three-day decline in U.S. equities. Medline's CEO is ringing the opening bell over at NASDAQ. Of course, we're waiting for those shares to begin trading under the ticker MDLN, and members of accounting firm Andersen celebrating its IPO at the New York Stock Exchange. Let's take a look at some stocks to watch right now. Netflix moving as Warner Brothers advises shareholders to reject Paramount's hostile takeover bid due to concerns about financing and other terms. OpenAI is said to be in initial talks to raise at least $10 billion from Amazon and use its Trainium chips. That's a potential win for Amazon's effort to broaden its presence in AI. And Oracle dropping on a report that Blue Owl will not back a $10 billion deal for its next data center. Oracle is now saying that final talks on an equity deal for a data center project in Michigan is, quote, on schedule. The stock lower by 2.8%. Big picture. My next guest says that the global economy proved remarkably resilient in 2025, weathering policy shifts, trade tensions, as well as inflationary pressures. Principal Asset Management's Seema Shah says that moving into 2026, the same forces that underpinned last year's growth, strong household and corporate balance sheets, agile policy responses, and accelerating AI investment are reshaping the macro landscape in significant ways. Seema joins us now. So Seema, we talk about some of those driving forces. Do you see them waning or picking up steam in 2026?
So they actually stay fairly consistent for this year, for 2026. There's a couple of changes. So we are expecting the household balance sheet to stay pretty strong. Corporate profit margins are at cycle highs. So that's providing this cushion. Now, we know that that's at the surface level, particularly in the household balance sheet side, because we keep hearing about the K-shaped economy. And certainly from the Trump administration side, that will be, I think, a key focus for 2026. So there could be some deterioration, there could be some strains for those lower income earners in terms of the way that they spend, the magnitude of their spending. Thankfully, we will see the government fiscal stimulus coming through with the One Big Beautiful Bill having a nice bit of injection, cash injections almost for households, as well as pushing down the effective corporate tax rate for corporates in 2026. So those are the kind of the new things that are coming through. And then, of course, there's a very, very important pillar, which is relatively new, which is AI CapEx. And we're not really seeing any clear signs that there's going to be a meaningful slowdown. So as we're looking through to 2026, this is still a really constructive macro backdrop, ideally with less policy uncertainty that was shaping part of the first half of this year.
This constructive macro backdrop, that definitely appears to be the consensus. People are really looking ahead to 2026 and saying that they see more of the good stuff, more of the tailwinds that we got in 2025. How much of this is all priced in? I mean, is the best scenario priced in right now?
You're right. So this is very much a consensus view. It's almost a struggle to find anyone who's very, very negative about the growth outlook. The kind of the key risk, which is sometimes being flagged, but I don't think with any significant conviction, is really around inflation. What questions around, are we underpricing the risk that inflation is going to take off? We're not seeing any clear signs of that, but we do admit that that is a risk, particularly when we're coming off the back of tariffs and we're ultimately just looking for how companies are going to be behaving in the first 2 quarters of next year. The other big risk, of course, is going to be around AI, and we have seen that narrative shift where there's more and more questions. So I'd expect that every earnings season will be looking for proof of delivery. Really, are these companies delivering on these expectation earnings? And can they continue to reassure concerns from investors that there is a bubble building up? So we think that they will prove, I guess they will continue to deliver on those earnings, but I do expect that caution, that concern to persist through 2026.
That persistent caution will persist. It's going to be something of a backdrop for investors. So do investors start to broaden out their focus beyond the big tech names in the U.S. to the rest of the market in the U.S., to other companies outside of the U.S.?
Yeah, and as you can imagine, this is really the key question for investors. No one really wants to be left behind in the tech story. There are concerns about the bubble, about a bubble. But that still doesn't mean that they want to necessarily move away from tech exposure. And certainly that is our view as well, that we do think it will continue to be a leader. But there are other ways of positioning the portfolio, kind of adding some elements of diversification, as well as trying to build on something that could be fairly impressive gains for next year. So with a positive cyclical backdrop, we should see this broadening out of gains. We're expecting it to see in areas such as financials, just from a general positive macro side. There's also going to be other sectors which are going to be performing well as they feel the benefits of the AI adoption that they've been taking on. Even on a cap side basis, we think that with a strong macro backdrop, as well as you can side that with a couple of Fed rate cuts, that is typically good news for small cap. And then, of course, there's the rest of the world. So really looking outside the US, typically we're seeing investors still trying to stay with the tech theme, but they're looking to Asia, saying, well, look, there are slightly cheaper valuations. There's some really good news stories. And if you really want to be outside of tech, or at least have some diversification, then they're looking to Europe and saying, look, there isn't as much exposure to technology within Europe, but they are still set up to benefit from AI adoption gains. So there's a lot of positive stories out there that you don't just have to be in the mega cap tech story in the US.
Got it. But because so much of it is concentrated in the mega cap tech space in the U.S., that's really helped bolster GDP, at least here in the U.S. How are you thinking about this differentiation and what that means economically for the U.S. and for other countries?
Yeah, we still think that the US is going to be the strongest performer for next year. You know, I think it's one of the few countries where you're seeing this combination of monetary stimulus as well as fiscal stimulus. There's not many of them out there. And then, of course, with, as you said, the composition of GDP really made up so much of AI and the capex that's going on there. That's another propeller. So the US is still the strongest performer, but that doesn't mean that other countries, other regions aren't going to do well, particularly from a valuation perspective. So, for example, for Europe, valuations are quite attractive relative to the US. It doesn't have as much exposure to tech, though, but the fundamentals of those valuations almost balance out to have an attractive offer for some investors.
What is your biggest concern, Seema, as we head into 2026? What's the one thing that you can't shake? You mentioned inflation. You mentioned, of course, the whole AI narrative and how it's shifting a little bit. But what seems to be the thing that could really disrupt the consensus view?
Well, I think the biggest risk is still going to be the AI concerns, but I think the most pertinent risk potentially is going to be in the fiscal side, partly because the US story is so much intertwined with what's going on globally. So let's say that there were a bad news story in another major developed market around the world in terms of their fiscal stance, their fiscal positioning, then that's something that I think the US is fairly vulnerable to. So that is probably the most the highest risk, the most pertinent risk, I guess. But the biggest risk would certainly be the AI story really starting to fall apart.
Starting to fall apart. We'll see how it all shapes up. Oracle, perhaps the poster child for a lot of that anxiety. Seema, really appreciate your joining us. Seema Shah of Principal Asset Management. Thank you so much. All right, let's get a check on the stock market right now. You are looking at a net change that's in the red here for the S&P 500. In terms of the moves, we were set up for a higher open here, but you're looking at Amazon, Apple, and Netflix as the biggest point contributors to the S&P 500 at the moment. On the negative side of the ledger, NVIDIA, the biggest company here in the S&P 500, Alphabet and Broadcom are the big decliners at the moment. Let's take a look at the sector performance here. Within the S&P 500, you have 11 industry groups, and energy leading the way, up almost 1%. Consumer staples up by 0.5%. General Mills, a big part of that story, and financials gaining 0.5% as well. On the downside, communication services losing about 0.5%. Tech down 0.4%. Utilities lower by 0.2%. Add it all up, and you have an S&P 500 that is currently unchanged at the moment. Coming up on Bloomberg Open Interest, Oracle dropping this morning as Blue Owl bails on a $10 billion deal for its next data center. We've got details next. This is Bloomberg Open Interest. It's time now for our top calls, some of the analyst action in focus this morning. First up, Wells Fargo cutting its rating on Sweetgreen, warning that the salad chain's 2026 outlook remains pressured as fast casual demand softens. The stock up about 1/3 at the moment. Next up, Telsey is upgrading Urban Outfitters and Victoria's Secret. The firm sees an improved path of momentum at Victoria's Secret. The upgrade on Urban Outfitters reflects new concept growth. Those shares both higher right now. And finally, Jefferies downgrading Constellation Brands, the parent company of Corona Beer. The analyst warning that prolonged weakness among Hispanic consumers weighs on sales and erodes its earlier confidence in a near-term recovery. Constellation Brands now down about 1.6%. And turning to tech, Oracle dropping on news that Blue Owl will not back a $10 billion deal for its next data center. Oracle is now saying that final talks on an equity deal for a data center project in Michigan is, quote, on schedule. Bloomberg Intelligence Global Head of Tech Research Mandeep Singh joins me now at the desk. Yet you see Oracle shares down, and Oracle's been kind of the poster child of anxiety over AI bubble fears. What does this latest headline mean for those concerns?
That if you're a neo cloud or someone like Oracle, funding your data center build out may get harder because everyone sort of needs AI data center capacity now. No one wants to fund it to build something that's going to be live 3 to 5 years out because you don't know the shape of the revenue curve that an OpenAI may have, because in the end, Oracle's more than half of their backlog is linked to one company, OpenAI. And if OpenAI is partnering with Amazon, partnering with AMD, and everyone else, then what does it mean for the demand that Oracle may have 3 years from now? And I think that's the big question mark here.
And you see that reflected in all, not just the equity, of course, but also in its bonds and in the credit default swaps. I'm so glad you bring up Amazon, because OpenAI is in talks to raise $10 billion from Amazon and use its Trainium chips. Where does this place Amazon in that circle, in that chart of circular financing around OpenAI?
I mean, right now, OpenAI's approach seems to be to, get chips or funding from whoever they can. They even got $1 billion from Disney. And, so they are doing partnerships, with any and everyone they potentially can on the chip side, on the content side. But I think what really triggered this for Amazon is Anthropic really moving very clearly towards Google GPUs. In fact, Anthropic has a $10 billion order with Broadcom now to ramp up Google TPUs as their own chips for training and inferencing workloads. And so from that standpoint, Amazon, having invested $8 billion in Anthropic, didn't really result in that partnership getting bigger in terms of Anthropic using more Amazon chips. And to me, NVIDIA GPUs and Google TPUs are way ahead of AMD and Trainium right now in terms of the accelerator chip capacity that everyone wants to deploy their AI on.
Is it fair to call these Trainium chips from Amazon AI chips, or they're not quite there yet?
Well, they are still in their 3rd version. So when you compare that to a Google TPU, which is in its 7th version, and really, obviously, NVIDIA is way ahead of everyone else in terms of the number of versions they had with their chips, and every version has a performance upgrade. So from that standpoint, Amazon still has some ways to catch up to these two, NVIDIA and Google TPUs.
Okay, got it. We've seen investors start to really make a discernment between NVIDIA and Amazon and certainly Oracle. Who's coming out ahead? Who surprises you in terms of a company that's kind of shot up to the top of the list?
I mean, right now it's Google this year, and that's reflected in their stock performance, not only because they've been able to defend their search business, they've done phenomenally well when it comes to their own chips and the vertical stack integration. Look, for someone like Amazon, I mean, clearly they want to add as much cloud capacity and partner with, LLM providers because they don't have their own LLM like a Gemini for Google. And so from that perspective, Oracle trying to build just the GPU business, again, for a demand that's further out, that's the concern. But look, everyone still believes that there will be $3 trillion in aggregate spent on AI infrastructure through 2030. The question is it going to be winner take all when it comes to LLM side, which was the the narrative with OpenAI, but that seems to have shifted because all these 4 or 5 LLM providers are neck and neck when it comes to new model releases and functionality.
Okay, so from cutting edge technology, let's go back to something that's a little bit more old school, which is memory chips. Micron will be reporting earnings today after the closing bell. And this is a stock that has done phenomenally. It's up almost 180% this year. Based on memory chips, what is the tie to AI here for Micron?
I mean, look, how does AI work? AI can do a lot of personalization if it knows a lot more about you. And that's where, a Meta is trying to apply a lot more AI chips to their ad targeting. And, all these companies that are developing virtual assistants need, chips with a lot of memory. And that's what we are seeing in the demand. I mean, Micron is sold out for 2026. And it's still an oligopoly, so it's not as if you're going to have a new memory chip player. It's still SK Hynix, Samsung, and Micron, and all of them are sold out because for inferencing, you need a lot more memory. For training workloads, you needed a bigger compute cluster. For inferencing, you need a lot more memory, and that's a nice tailwind for all these memory players.
You said they're sold out for 2026. Demand is certainly seen as robust. The competitors are those in Asia. What does the supply globally look like then?
Well, so all these companies, I mean, Micron, for example, doesn't have a big China business. So, SK Hynix is still the primary provider for someone like NVIDIA. And so when you look at the DRAM market share, that's how it's translating into, the market shares that we are seeing in HBM, which is the memory used for these AI accelerator chips. And so from that standpoint, all these companies are adding capacity, but we are not at a point where we feel like we'll be oversupplied anytime soon when it comes to memory chips.
All right, Mandeep Singh, thank you so much. Mandeep Singh of Bloomberg Intelligence answering all of our tech questions here this Wednesday morning. Coming up, Lennar, the home builder, disappoints. Affordability pressures mounting on the home builder as it navigates what it calls a challenged market. The stock, you can see they're down about 5.5%. That's next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. We're 20 minutes into the trading session here on this Wednesday morning, and you're looking at stocks, at least for now, in the red. Not by a whole lot. The S&P 500 marginally lower. The NASDAQ 100 losing about 1/3 here, as you see some big decliners in the biggest name, NVIDIA. And in terms of actual names, OpenAI said to be in initial discussions with Amazon to raise at least $10 billion from that company and use its Trainium chips. You could see Amazon getting a bit of a lift, up 0.3%. And of course, the other big story that we're continuing to cover probably through the next year and a half is a Warner Brothers Discovery bidding war. Netflix moving as Warner Brothers advises its shareholders to reject Paramount Skydance's hostile takeover bid due to concerns about financing and other terms. Paramount Skydance currently off by 3.5%. Jared Kushner's Affinity Partners private equity firm also pulling out of that deal as well. And keeping an eye here on Zillow and Lennar, both shares are in the red right now. Lennar's forecast for quarterly home orders missing analyst estimates. Those results came out yesterday after the bell. So for more on those results, Bloomberg's markets correspondent Nora Melinda joins us now. And Nora, when it comes to Lennar and the home builders, it all comes down to affordability concerns.
Absolutely, and that's what we're really seeing being displayed here through Lennar earnings. Of course, we know Lennar does focus on first-time home buyers. They have move-up buyers and just your traditional, any sort of buyer here. So they really do have a diverse group of a target audience here, but we are really hearing a forecast for the first quarter that's not positive. They're reporting first quarter earnings, gross margin, and deliveries that all are falling short of expectations. So this really is just underscoring the pressures that we've really been seeing in this market as you think about affordability pressures, as well as a lot of job insecurity that's going on right now in this time period, Scarlett.
Yeah, the softening job market can't help, but it is notable that interest rates have moved somewhat lower, and this is something that Lennar pointed out in their results.
Right, and we are seeing a pullback in rates, as you're mentioning, but we are also seeing some increased competition from the resale market. So that's also adding to luring the buyers, trying to figure out what makes the most sense for them. But what's really also been weighing on Lennar in particular, we're looking at shares of Lennar down about 17% so far this year, and we've really been seeing them dealing with a lot of incentives that's weighing on margins. So they are trying to lure buyers in by saying, hey, let me take your mortgage rate and bring it down by about 1% to make it more affordable, enticing for the buyers to come and purchase from them. But it also is weighing on profit here.
Yeah, absolutely. Those incentives, bring the volume up, but at the expense of profitability. So how is Lennar adapting to this new normal of affordability concerns and the fact that it needs to offer all these incentives to buyers?
That's the balance that we are hearing investors really looking for them being able to see displayed as whether or not they're able to strike this balance here. I mean, we had Barclays saying that even though deliveries may rise, this also does come at the expense of margins as we look ahead to the first quarter. So it's about whether or not they're able to adapt and also maintain competition, a competitive edge against the resale market. And then also we are seeing, of course, a lot of demand as we think about the competition that's coming from its direct competitors as well.
Yeah, so I think it's really interesting you point out about the competition from the resale market, because that is the bigger part of the housing market.
Absolutely.
New construction is not giant in terms of market share.
Right, and if you think about the fact that home builders had been doing well in years past, just off of the fact that there was a scarcity of available homes on the market that were previously owned. But now we are seeing people who are trying to shift a bit, and actually we are seeing people who were owning homes previously now putting it there on the market. But of course, rates still remain high. We've also got tariff concerns that still remains an issue when we think about the access to materials for this market in particular. But additionally, just the consumer right now, they're incredibly strapped. And for a lot of people, as much as they may want a home, it may not be the first on their priority list right now when they think about financing.
Yeah, so in terms of inventory, we see more listings in the resale market. What does inventory look like for the builders themselves, for a Lennar, for a Pulte Homes?
Yes, so they certainly have a lot of inventory. So we are also seeing that as a competitive push against Lennar when we think about the fact that a lot of its competitors do have a lot of inventory on the market, which makes it more challenging for the likes of Lennar. And you're definitely seeing that reflected in the trade. I mean, of course, we do see Lennar leading a lot of these home builders lower as we are looking at the trade so far this morning.
All right, good stuff. Nora Melinda, thank you so much. Bloomberg Markets correspondent Nora Melinda with Lennar's latest results. They came out yesterday, and a disappointing read, at least if you were looking for a rebound in the housing narrative. In terms of what we're seeing right now in the early trade, you're seeing a mixed picture. The Russell 2000 gaining 0.5%. So all those predictions of the market rally broadening out, perhaps that's taking place, the rotation away from the mega cap tech names and into some of the smaller names like the Russell 2000. The S&P 500 currently lower by 0.1%. This would mark a fourth straight day of declines if we hold on to these declines. The NASDAQ 100, the leader here in terms of declines, lower by 1/3%. We'll continue to keep an eye, but NVIDIA among the decliners here. Amazon holding on to a gain of 0.6%. Coming up in the next hour, Threadneedle's Ann Berry joining us next on what she sees as a true hidden gem in Netflix's bid for Warner Brothers Discovery.
30 minutes into the trading day here with the markets trying to get their mojo back, a series of soft prints over the last few days. No day today quite different than the others. I'm Romain Bostigin today for Matt Miller and Danny Berger on assignment. Coming up here on the big show, stocks trying to find their footing as Wall Street gears up for another data print, this time inflation. That's coming in just about 24 hours. We're also going to take a look at this year's biggest IPO, Medline, making its trading debut today after raising more than $6 billion. Plus, President Trump set to deliver a prime-time address to the nation tonight to tout his agenda to voters heading into 2026 and a midterm election year. But we begin with caution on Wall Street. Seema Shah, Principal Asset Management, weighed in on what her biggest concern is for 2026.
The biggest risk is still going to be the AI concerns, but I think the most pertinent risk potentially is going to be in the fiscal side, partly because the US story is so much intertwined with what's going on globally. So let's say that there were a bad news story in another major developed market around the world in terms of their fiscal stance, their fiscal positioning, then that's something that I think the US is fairly vulnerable to.
Seema Shah speaking a little bit earlier. Joining us right now here in Studio 2 is Ann Berry, the founder of Threadneedle Ventures. Great to see you, Ann.
Good to see you, Romain.
When we talk about sort of the structural issues, and more importantly, I guess the structural opportunities heading into 2026, is that still going to be an AI story?
I think it is an AI story in terms of the risk. And for me, what I'm looking at is how much does credit stay away from or remain cautious around investing in this sort of series of circular AI deals that we're seeing. I think if credit can remain sensible, if we see the balance sheets of the biggest players like Amazon today who can afford to make the size of bets they're making at the moment so it's contained, I think we're all right. But we would like to see some broadening out.
There are a lot of people, though, they look at Oracle, they look at its debt needs right now, and they're kind of trying to see whether that can be sort of the canary in the coal mine. Is Oracle just its own story, or do you maybe see something broader that investors should be wary about?
I think you're seeing others, Romain. I think you're seeing the market now saying we think that there are those who are better positioned in terms of the strength of their balance sheet than others, and you're seeing that reflected in their share prices. The sell-off in CoreWeave being a case in point, right? That is the market very clearly saying we're not so sure this is a winner anymore, but continuing to pile into the likes of Alphabet, saying there we clearly see the value thesis.
I do want to get your thoughts here on another deal that's been working its way through the market, and that's what's been going on with Warner Brothers Discovery. We got a formal letter out of Warner Brothers basically urging its shareholders to reject Paramount's offer, embrace Netflix's offer, and now we're learning right now, crossing the Bloomberg terminal, Paramount weighing in, saying that it's affirming its commitment to its original $30 a share offer and saying it's highly confident that it would get the regulatory approval over Netflix's bid. Where do you think all this is going to go? Because on one hand, this is about, of course, the cost of the deal. On the other hand, this is also obviously about politics in Washington and what would be most palatable to the White House.
There's a third thing it's about too, Romain, as we all bring out the popcorn and keep watching this one, right? And I was having this conversation with the co-head of M&A at Doucera actually yesterday evening. And one thing is, Paramount previously said, this is not our final offer. Do you remember this when they came out with this offer? They've reaffirmed their price today. But if you're the Warner Brothers board, you've got to play this out to try and see if there's another bid that they can get out of Paramount, and as a result, to see if there's another bid that they can get out of Netflix. Just look at what we saw with Pfizer and Novo Nordisk, right, in the battle for Metsera. I'm not so sure that this valuation is done yet. I think we're going to see another play of that, perhaps.
Do you worry that the valuation might be getting a little bit too far away from reality based on what we know about Warner Brothers?
Yeah, I do think that, but I think that is sort of irrelevant in the sense that you've got two players. Netflix can absolutely afford to move a little bit more. It may have the discipline not to. Paramount, who's made it very clear that they want this for reasons that are not entirely about valuation. And so I just think the winner here is going to be the Warner Brothers shareholders.
And also, of course, Warner Brothers investment bankers, Warner Brothers
lawyers
as well. But speaking of which, I mean, what do you make of this big boom that we've seen in deals in the second half? A boom that most people think is going to continue into 2026. It's not just Warner Brothers. There's a whole slew of companies out there that seem to be on the table. And it seems like investment bankers right now are singing pretty high tune. Right?
Oh, yeah, it's been a fantastic year. We've seen that in the bank earnings where there are big advisory franchises. I think the other piece that we haven't seen quite yet this year, but with rates coming down, potentially again next year. We haven't yet seen the boom in private equity deals.
Yeah.
Right? So that to me is the next phase of where more interesting things can come. So I think this Netflix deal, it's fascinating because so many of us consume the product. But there's been a lot of other M&A activity. And don't forget the IPOs too, another great revenue stream for banks over the course of 25.
Absolutely, and we're going to talk about that Medline IPO. We talk about not just the biggest IPO of the year, but the biggest private equity exit, I believe, right, in all time, and into public markets at least. But it gets to this idea, though, too. I mean, you mentioned the Fed, you mentioned rates. How much does that actually matter in the grand scheme of things for the continuation, of obviously the public equity boom, but also the facilitating more activity in the private space?
Well, I think let's start with the equity boom with the stock markets. I think if these rate cuts were not happening, or there were lower confidence that they weren't happening, I think we would see the market getting a little bit spooked. There's a real sense that we are going into a different monetary environment. We've got President Trump, as you said, top of the show, giving his comments for next year. We know he's interviewing potential Fed chairs to replace Jay Powell, and that will influence the rate path over the course of 26 and 27. I don't think it's stimulating. I don't think rate cuts are stimulating more capex. Okay, I don't think they're stimulating more borrowing activity, but they are stimulating sentiment. And then on the private side, I think that's where it gets more real. There are real concerns. I had them at the beginning of this year, and you've seen it. Restructuring activity has quietly been pretty high in 2025, and I think seeing that interest rate pressure come off in the private market is going to be very important.
With some of that pressure coming off, do you think investors, and I'm talking more on the limited partner institutional side, are going to be more receptive to investing in more deals? And I guess more importantly, are they going to even have the cash to do it?
Well, that's a great question. LPs are saying we need our money out. You know, okay, private equity, put a bunch into your funds, that 2019 to 2022 vintage, you've got to start showing us the money. And it's delayed. Now, on the flip side, you've had some of the mega funds who were able to raise big new funds over the course of sort of the last 2 to 3 years who are sitting on dry powder because they've been looking at these public equity valuations and said this is actually not the most obvious time to be deploying capital. So you've got that sort of double whammy, but I think it does maybe shake a little bit loose next year.
Okay, all right, but overall you're optimistic for next year?
I'm sanguinely optimistic.
Sanguinely optimistic,
yes,
I like that.
Exactly.
And always a pleasure. Ann Berry, founder of Threadneedle Ventures, here as we check in on the markets just now about 36 minutes into the trading day with the S&P 500 basically flat on the day. The NASDAQ indices slight dip into the red, but you are seeing less of a sell-off and more of a rotation into some of those cyclical areas. You see that reflected in the Russell 2000, which is up about 0.7% on the day. The mid-caps up about 0.8% on the day. And you see the yield picture here, something to keep an eye on as we head into 2026. A little bit of stasis ahead of that inflation report tomorrow, but really probably a bit of stasis till we get some more clarity out of the Fed into January and 2026. As far as some of the individual movers out there, it is a hodgepodge at the top of the leaderboard to the upside here. But we do want to make sure we are keeping an eye on what's going on with the saga right now, the trifecta, Netflix, Paramount, Warner Brothers, Discovery. A big question right now is as to whether Paramount can actually convince Warner Brothers shareholders and its board that it is the superior bid to Netflix. Is for right now, shareholders seem to be gravitating to the Netflix side of the equation. When we come back, we're going to take a closer look at what's going on elsewhere in the markets today, including talking about Oracle, pushing back on some of the questions here about its data center project, saying it's in final talks on the equity deal for that big project in Michigan. That is on schedule, and it doesn't include Blue Owl. Coming up here, Morgan Stanley's Megan Clapp going to be joining us to talk about the impact of tariffs on the toy industry. That's coming up next here on Bloomberg Open Interest. Stick with us. All right, let's talk Hasbro. Its trading card game, Magic the Gathering, has become the growth engine of the company. Magic, now 30 years old, and Hasbro is looking to keep it fresh by bringing in themes and characters from other franchises. On the latest episode of Bloomberg's Chief Future Officer, the company's CFO, Gina Getter, tells Matt Miller how Magic's fan base is greeting those changes.
It is a vocal and healthy fan base. And as we launched into Universes Beyond, there was a bit of this, how are our core players going to respond? And is it going to do the job? Are these Universes Beyond releases going to do the job of engaging the core while at the same time building and kind of attracting new users or new players? our first one that we did was the Lord of the Rings set back in 2023. And that one was wildly successful as well. And our original hypothesis was it was going to be a lot of new players coming in. But what we saw when we did Lord of the Rings was actually not that. We initially saw our core players engage in the IP. We also saw a lot of lapsed players get re-energized or re-interested in the game.
There are currently about 30,000 Magic cards, with more coming as Universes Beyond expands. But even in the age of AI, the designs are being made by humans.
All of the cards that you're looking at here are artist-driven. We are not leveraging AI to make our cards. So that is a place that we've kind of said, no, we are for the artists. That creativity is going to come from humans. We can leverage AI within Magic to speed up processes, but the actual art itself that you're staring at is coming from our artists themselves.
Can you bring it into the actual gameplay?
I think AI is going on the gameplay, whether it's D&D or Magic, will be an enabler, especially like with Magic. It is a complicated game. But now that I know the basics, as I go to play, I am able to leverage AI to help me facilitate my learning. I think that's a very individualized experience, but we know that getting players and attracting new folks in, having them learn how to play is a key element to that. I think that AI is going to be an enabler to help us get those people learning faster.
And that was part of the conversation Matt Miller had with Hasbro CFO Gina Getter. That's going to be on the latest episode of Chief Future Officer, which you can catch the full episode tonight on Bloomberg.com and on YouTube. Now, we do want to continue our focus here on that company and some of the changes that Gina and the CEO have made to improve things. The stock, of course, on a run this year, up more than 40%. Joining us right now is Morgan Stanley analyst Megan Clapp. She's got an overweight rating on the stock and a $94 price target. Megan, great to have you here.
Yeah, thanks so much for having me.
It seemed like a pretty decent hire a couple years ago to bring Gina on board here. Talk about some of the changes that you've seen over the last year and a half or so with regards to just making that business model more sustainable.
Yeah, absolutely. I think it really starts with close to 3 years ago when Chris Cox came in as the CEO of Hasbro. He was running the Wizards of the Coast business prior to that, gaming focus, and he really took on a strategy for Hasbro of transforming the company into more of a games and IP-driven company. And the result of that is the mix is now shifted to higher margin, higher growth businesses, and that's driving more sustainable and durable growth for the company. Gina came on about a year later as the CFO and then later the COO, and she's been on a journey to really transform the supply chain and transform the consumer products business, which is the legacy toy business. They've simplified the portfolio, they've cut a lot of cost out of the supply chain, and the net result of that is a really bright outlook, in our opinion, as we look ahead to 2026 for the toy business.
With regards to the toy business, we came into this year, particularly with the change in the U.S. administration, a lot of concerns about tariffs, how that would affect a business that is heavily reliant on overseas goods. Just kind of put into perspective, how much of Hasbro's business is actual in physical toys and how much they were affected by the tariffs?
Yeah, absolutely. I think all of us think about Hasbro as a traditional toy business, Transformers, Nerf, Peppa Pig, all very important.
All fan favorites.
Yes,
yeah.
all very important franchises for the company. But
I still have some of my Transformers when I was a kid, by the way.
Very important franchise, and it's still going to be an important franchise. I think I want to emphasize that the toy business, I think, is going to be a long-term part of Hasbro's portfolio. But as they've executed this strategy and this mix shift, an interesting stat today, over 80% of operating profit comes from the Wizards of the Coast business. That's driven by Magic the Gathering predominantly, Dungeons and Dragons, as well as some of their new digital gaming efforts. Toys are just 15% of operating profit this year. It's around 50% of the total top line, but disproportionate. Magic is a disproportionate share of the profit. Part of that is because they've been going through a transformation. They've had some struggles in the toy business, and we do expect the margin profile of that business to improve. But the reality is the business has just shifted, and they're not as heavily reliant on the toy business anymore. So they've certainly had impacts from tariffs this year. It's hurt the entire toy industry. You've seen it in their margin performance, but just given the strength in the rest of the business, Magic's up over 40% year to date. It's masked, honestly, what's gone on with tariffs in the toy business.
With regards to when we start to see some of the new games come out, the D&D games, Warlock, and of course the Magic one as well, I think 2027 is now kind of the projected target that we're going to start to see those come to market.
Yeah, absolutely. So digital gaming is a bit of a new venture for Hasbro. This was part of Chris's strategy when he stepped into the CEO role. And what they're doing is it's a balanced strategy. So it's a combination of partner-driven and licensed models. Monopoly Go, a perfect example. And what's interesting about something like Monopoly Go is it's very capital light. The Hasbro did not make any upfront investment. They just collect a royalty. Monopoly Go ended up being the exception, not the rule, but it's about 15% of Hasbro's operating profit this year, again, with very little upfront investment. So a really accretive venture for them. What you're going to start to see in 2027 that you alluded to is this targeted push into self-published games, self-published video games.
Yeah.
In 2027, we'll get Exodus, which is a new IP, a sci-fi role-playing game, and then we'll get Warlock, which was announced last week at the Game Awards. That's based on D&D, which is a known IP. So you'll have a new IP, a known IP, 2 video games that we expect to launch in 2027. And what I think is interesting about the video game strategy is everyone always worries about video games. It's it can be a lucrative business, but it's challenging. In our opinion, I think we view it as a call option because the market is so skeptical.
But what about the upfront cost for that? I mean, how does that compare? And I'm particularly referring to the new digital ones that they're pushing.
Yeah, the upfront cost is much more significant, right? So we estimate Exodus is in the range of 200 to 250 million of upfront costs for the game. That's just pure development games. There's marketing costs on top of that as well. What's great though is all of those costs have already been spent. So they're capitalized on the balance sheet. They'll have to flow through the P&L. But even if they sell 1 unit, that's incremental to free cash flow. And free cash flow, in our opinions, how you think about intrinsic value of a business. So yes, there is an upfront cost to it, and we'd like to see them at least break even. But we think at this point, with how skeptical the market is, anything is incremental to free cash flow.
All right, Megan, great analysis. Great to have you here on the program. Megan Clapp of Morgan Stanley, a closer look at Hasbro. Again, a stock right now on a 40% run on a year-to-date basis. When we come back, we're going to talk about one of the newest entrants to the market and the biggest of the year. Medline is set to make its trading debut in moments. The shares indicated to open at about $31, slightly above where it priced at $29 last night. That's coming up next on Open Interest. This is Bloomberg. As public equity markets are open and stocks are trading, we are awaiting the start of trading for one of the biggest of the year. Medline, a medical supply company, sold shares last night at $29, and we are waiting for it to open today. It's a $6 billion IPO, the biggest of the year. Joining us right now to talk a little bit more about it is Bloomberg IPO reporter Bailey Lipschultz. All right, Bailey, let's first start off with the numbers here. $29 seems pretty good. Is that above where we were looking? And where do you think the shares are going to open once all the market makers get everything sorted out?
Yeah, I think there was some kind of price sensitivity talking to investors and bankers around that $28, $29 figure. The big expectation is that Upsized, so selling a few $1 billion more of stock than many were expecting when they went to market throughout the last week. So the expectation right now with that to open up at 31, again, about 7% higher than the IPO, but these are private equity deals that are built to, perform well, but not be the tech type of deals that triple or double in the first day.
Yeah, it's kind of interesting. Everybody keeps talking about also this being the biggest IPO. But Bailey, I think one stat that really jumped out at me was that this is actually going to be the biggest, basically private equity-backed IPO, at least majority private equity-backed IPO, I think of all time, if my math is correct.
Yeah, and that's what we've been reporting. So when you look at this deal, the kind of debate when you come into the year as it relates to private equity deals is, okay, what is a normal company size that's going to go public via IPO? When we talk to private equity sponsors, what is too big to be sold to either other private equity firms or strategic acquirers? And Medline really fits that bucket. So in terms of IPO raise, yes, the biggest of all time, according to our data. And then in terms of market cap, again, you don't normally see companies going public at the size and scale that Medline is. And this is a consortium deal. So you've got Carlyle, Blackstone, and H&F in there. So a number of big firms as we all await kind of this to potentially be the first litmus test for private equity sponsored companies that we've been really pounding the table if you talk to bankers for a number of years to finally go to market. And then that's been a big theme when we talk year end of 25 into 26 in terms of expectations.
Yeah, absolutely. And we talk about the idea also it being a company that, doesn't really have any direct AI connection or any of the other sort of hot buzzwords of the year. The fact that they were able to get this out the door, and obviously we still have to wait for what the secondary market judges it, but the idea that they at least had something that was successful, I would assume that bodes well for those gigantic AI companies that everybody, and other tech companies, I should say, that are sort of in the pipeline, whether it's OpenAI's, Anthropic's, and more importantly, SpaceX. Do you think that market's going to be able to digest those? I mean, we're talking, close to $1 trillion valuations on some of those names.
Yeah, when you look at kind of the expectation around SpaceX, which we've reported is $1 trillion to $1.5 trillion, and when I talk to investors within some of those massive tech names, is there's going to be investor demand. There will obviously be a retail bid, but they're a completely different beast than a Medline. When you look at a Medline, you're talking about, again, a healthcare company. Healthcare's come back in vogue in the last number of weeks. The big question mark when you look at a SpaceX or an OpenAI or Anthropic for next year is really what does the market actually look like when they do come to market? Is there still so much excitement around data centers, or are we continuing to see more fears around a bubble, or at least uncertainty around valuations continue to perk their heads up? I don't think anyone would doubt the strategic importance of a SpaceX, OpenAI, or Anthropic from an investing, but also kind of a societal perspective. But the big question is, where do investors feel comfortable underwriting the risk and growth expectations? Again, completely different relative to a Medline.
All right, Billy Lipschultz covers IPOs for us as we await the opening of trading on Medline. Sold shares at $29 a share, a $6+ billion valuation here on what is now going to be just the 5th U.S. listed firm to raise more than $5 billion in an IPO in the past decade. Taking a look here at the broader market, the S&P down on the day, so too is the NASDAQ, though you are seeing the Dow and the Russell higher on the day. A slight uptick in yields on the day, but keep an eye on what's been going on in commodities. That's where a lot of action is. WTI crude, which fell below $55 a barrel, back above 56 here. And that relentless rally that we continue to see in silver continues for yet another day. 3% gain here right now in the session. When we come back here on Open Interest, a closer look at the AI boom and the fundraising frenzy with Deborah Jackson.
We're going through one of these periods where it's a glass half empty, and I get it. And I think it's healthy for the overall tech trade. But I think when we look out, I think tech stocks are going to continue to rip into next year because we're still early days in this AI build out. You only have 3% of U.S. companies that are going down the AI path.
Dan Ives over at Wedbush, always bullish on the AI story, talking about his outlook for 2026 as we talk about that funding frenzy in both public markets and private. Let's bring Deborah Jackson into the conversation. She's the founder and CEO of Plum, a venture firm that focuses on frontier technology and medical breakthrough early stage companies. Great to have you here.
Thank you for having me.
Let's talk about the AI frenzy, but maybe just go a step down, because typically we talk about it from the OpenAI's, Anthropics, basically the 800-pound gorillas in the room. There's a whole ecosystem under that, and we talk to a lot of these founders a lot here. Talk to me about the health of that ecosystem and the interest in investing in it relative to what we're seeing with the more marquee names, if you will.
Yes. The early stage sector, the venture capital area, is very robust. And when you think about it, even companies like OpenAI, where did they start 3 years ago? They were a smaller company, and look at them today. So innovation really happens at that very early stage, sort of underneath the radar. But with AI and other robust technologies, they come out of nowhere and they get traction. And why do they do that? Because they have massive potential and massive upside. So not only for the users, but also for the investors.
When you look at what we've seen, let's just peg it to 3 years ago when ChatGPT was kind of became into the public consciousness at least. That's kind of the marker. When you look at the type of money and the type of interest in this space right now, and the promise or the potential that this is one of these transformative, whether it's a new industrial age or whatever you want to call it. Do you see it as that lofty?
I see it as the most significant transformation that we are going to experience in our lifetime. And we are just at the early days of that. And you know what happens with all technologies, new technologies, is they come out of the gate and then everybody's excited, they sort of goes up, and then there's that trough of disillusionment where people begin to realize, oh, I want to use this technology, but it's not quite there yet. And we've seen that with hallucinations and the early LLMs, et cetera. But we're past that. And when I think about 2025, I think, okay, that is the time where this came out of the gate and people got excited, then they realized, oh, the adoption is slow. What we're going to see in 2026 is a massive adoption because these models are much better. The value is there, and they're all competing against one another, right? And you know, we're just going to see more adoption because the value is there.
Talk about specifically where you see value from an investing perspective. I mean, what are you investing in? Are you just kind of investing at that top layer, or is it more the end user type of things? Like, where do you see the potential investment return?
Yes, so we invest in the early stage, Series A level, so companies that are beyond an idea on a napkin. They typically have a product, they typically have a customer. And so the companies, and let me just give you an example, we've invested over 100 million in 33 companies. We've invested in CRISPR gene editing. We've invested in robotics. We've invested in a company that's refining rare earth minerals in the United States. So we've got a very robust portfolio. I would say when you look at all of our companies, and we're very specific about this, they've got to have something that is transformative, but also at scale will reach 1 billion people globally. So these aren't small things that, you know, are over on the sidelines. They are massive transformative technologies.
When you're looking at pitches, I mean, how do you sort of separate the wheat from the chaff? Because we know, as with every sort of big transformational boom, there are a lot of people that just are piggybacking. A lot of folks have just tacked AI onto their pitches and their business models, even though they aren't really doing that, at least not in the depth.
Oh yes, and you have to be very selective, and I will say the companies that we invest in and we're very bullish on are companies that are AI native. So they're not just a company that says, okay, we need more efficiency or more productivity, so we're going to add on this tool and we're going to start branding ourselves as an AI company. That is not what we do. We go for the companies that really have something new that no one else has. And by the way, it starts off with proprietary data. If you're any kind of serious early stage AI company, you've got to have a source of data that no one else has. And so we look at companies, a lot of them are associated with hospitals or universities and have a set of data. We just invested in a company that has a big partnership with Harvard Medical School, et cetera. And that company is detecting cancer 6 years before it will show up on any typical scan. And why can they do that? They can do that because they have a proprietary database over here that no one else has. Very, very robust, very transformative. And it's not the big LLMs that you see that are all competing for the same eyeballs and use cases. We're really looking here, the earlier stage, where, think like experiments in a lab or some breakthrough, especially medical breakthroughs. Now with the information that you can get on proteins, et cetera, we are seeing that.
You mentioned CRISPR, and I think about just how revolutionary that was when it first came out. And is there a sense here that we will see not just faster drug and medical discoveries, but more effective? I mean, because it's not just about the speed of which we get this stuff out, but also the efficacy as well. And I am curious if you're already seeing the potential for improvement there.
We are seeing, CRISPR is only one example. We are seeing improvement in many, many different areas. And, again, once you have the discovery, then it takes a period of time until you actually can go to market, et cetera. But the value is there. When you see the potential for CRISPR in diagnostics and therapeutics, or, let's take any other example, in robotics, when you see the potential, when you have robots in hospitals, we have one company that does this, there is the transformation of the benefit that goes to the humans. So a lot of AI, people are focused on, okay, efficiency, let's make it more efficient. Well, that happens, but like with robots in a hospital, who is the beneficiary? The beneficiary is the patient, because the nurse is now freed up to spend more time interacting with the patient. The robot can do all the mundane things like deliver meals, deliver medicines, et cetera.
All right. Deborah, it's a great conversation. Great to have you.
Thank you so much.
Deborah Jackson there over at Plum, a VC firm, focused on early stage frontier technology companies here on open interest as we check in on the markets here. A mixed day once again here as investors towards the end of the year. And we should point out volume a touch lighter than what it would normally be. People really trying to parse here the last big data point of the year. That will be the inflation report, the delayed inflation report here in the U.S. that comes out tomorrow morning. The S&P and the NASDAQ down. Some of the cyclical names are higher on the day. A lot of activity going on right now in the commodity space and a slight uptick in yields. As far as some of the single stock movers out there right now, all eyes right now are on Oracle, saying that final talks on an equity deal for a data center project in Michigan still on schedule, and it does not include Blue Owl. General Mills, sales there topping expectations as it improved packaging costs and lowered some prices. And how about the home builder Lennar? Disappointing sales forecasts out of that company last night. Affordability pressures, weakening job market, that's been the story all year long, continuing to push home buyers to the sidelines. Coming up here on the big program, FTSE Russell's head of global investment research is going to walk us through the bifurcation in the equity market and U.S. economic sentiment. That conversation up next on Open Interest. This is Bloomberg.
It's almost a struggle to find anyone who's very, very negative about the growth outlook. The kind of the key risk, which is sometimes being flagged, but I don't think with any significant conviction, is really around inflation. What questions around, are we underpricing the risk that inflation is going to take off? We're not seeing any clear signs of that, but we do admit that that is a risk, particularly when we're coming off the back of tariffs and we're ultimately just looking for how companies are going to be behaving in the first 2 quarters of next year.
Seema Shah of Principal Asset Management joining us to talk about a little bit here about what she sees as opportunity into 2026. Joining us right now here in Studio 2 is Indrani Day. She's head of global investment research over at FTSE Russell. Her latest quarterly report, she says the global economy shows resilience and notes continuing tailwinds for international assets. Great to have you here.
Thank you for having me. I'm glad to be.
Before we talk about 2026, I just want to kind of wrap up, put a bow on 2025, because we came into this year and there was a lot of concern, particularly in March and April, around some of the U.S. policies and what the effect would be, not only on U.S. growth, but global growth as well. When you look at where we are now and look back with hindsight, did things shake out as you expected?
Things actually happened much better than when people got very nervous around April and we had a bout of volatility. But the reality is that the global economy and U.S. economy have held up much better than expected. But what I want to point out is about just the headline numbers are pretty, consistent growing. But below that, there are massive changes, which is leading to dispersion and rotation in leadership. And headline numbers, global growth for 2026 is expected to slow down by just about 10 or 20 basis points. But if you see where that growth is coming in, you're having so much growth in the emerging markets, in developed ex-US, and that's showing up in how those equity markets have been doing so far. So this dispersion and the rotation in leadership are key themes coming out from where we are in the macroeconomy.
We'll talk a little bit about that because it's kind of surprising. I mean, if you were just focused on the U.S. market, and these are phenomenal gains, 15% on the S&P, almost 20% on the NASDAQ. But then, of course, you look at just broad EM indexes, far outperforming all of the major U.S. indices. And then even on an individual basis, whether you're looking at China and Hong Kong, some of the emerging markets in Latin America, also outperforming. Is that a function of what's been happening here in the U.S. or a function of maybe something good happening in those countries?
It's a function of rewiring how other countries are reacting to the policy changes emanating from the United States and the coming to fruition of a lot of structural reforms that have been happening in these countries over the last few years. So we started with the broadening of the rally outside the United States, both into other countries and other sectors because of the other pillars of growth that we are seeing in the global economy. Let's look at it this way. The AI, China is obviously doing a lot on the AI green transition, all the latest technology. Benefiting from that are the ASEAN countries, the EM in Asia. A lot of these new technology depend on commodities, and Latin America is really benefiting from that. That's why you see so much strength in Brazil and Mexico. Gold has become a major asset class simply because of the environment of uncertainty. So the gold mining stocks, South Africa is benefiting. And emerging markets in general have gone through so much fiscal consolidation, getting their balance sheets in order. Those strength, which showed first in their fixed income market, has now gone on to the upside, meaning the risk asset equities. And that's why this year to date, November 30th, emerging market equities have been ahead of developed markets by about 3 percentage points. That's fairly significant. And sorry, go ahead.
Well, I see the returns. Is the money actually following it? And by that, I mean, we talked earlier this year about how there was this rotation to a certain extent out of U.S. assets into non-U.S. assets. Depending on what data point you look at, that's either true or not true. But the overall, is there more actual investor activity in those nations?
I would say yes. And one simple point that I would say is, for years we have heard that developed or ex-US markets have lower valuation, and lower valuations can continue for a very long time. What has shifted in 2025, if you see the valuation re-rating, the extent to which valuations have gone up, they have gone up in the US also, but the extent of going up is much higher in China, in developed Europe, in Japan. So when valuation re-rating happens, that's because there are capital flows at play, and sentiments have shifted and capital flows are at work, because of which the valuation re-rating has gone up. So, valuations remaining lower always has been, but the re-rating has been more in these other countries. And today their earnings growth is expected to be higher than the US by anywhere between 1.5 to 3 percentage points. Earnings revisions in many of the countries like Japan, massive increase in earnings revision, and probably more to follow with all the reforms and the new prime minister and the policies to play. And don't forget, we need to look at equity risk premium. Are people getting paid? And the equity risk premium is certainly higher in developed Europe and Japan. So look at earnings growth, look at earnings revision, look at valuation re-ratings. Those are the fundamental data points that really point to the fact that something has shifted, and we need to be more diversified to pick up that.
I do have to ask you about China and investing in China. There's a great story on the Bloomberg terminal today about how China went from basically being quote unquote uninvestable because of the political issues to indispensable, their words, not mine. And it gets to this idea as to whether investors really ever left China, foreign investors, that is.
See, the global economy is becoming, I wouldn't say fragmented, but certainly, it's standing on more pillars and more countries, and China is certainly one of them. I mean, it's the second largest economy. There is a lot of innovation happening, albeit a different kind of innovation from the United States, and it's getting their exports. Look at it. I mean, we had all these tariff tensions, but China's exports to the rest of the world have actually increased. The destinations have changed, right? So this rewiring, they have been pretty successful, I would say. And global investors follow where the expected returns are. And they also want to keep their risks diversified, not have very concentrated portfolios or concentrated sources, drivers, so to say. So to that extent, yes, people have stayed there.
All right. Great conversation, Indrani. Really appreciate it.
Thank you so much.
Indrani Day there, the global head of research over at FTSE Russell, as we continue here on Open Interest. When we come back, we're going to push ahead to tonight. The President of the United States expected to deliver a national address during prime time to not only tout his accomplishments in his first year of office, but more importantly, to talk about his agenda for 2026. That's coming up next here on Open Interest. This is Bloomberg. It's been almost a year since President Trump was sworn into office for his second term, and he plans to take to the stage tonight to tout his agenda in a primetime address to the nation at 9 p.m. Eastern Time. Joining us right now is our Bloomberg Washington correspondent, Tyler Kendall, who's outside the White House. And Tyler, first let's start off with what we expect the president to actually say. Is this going to be like a policy speech or a rah-rah? Just pat us on the back and wish us a Merry Christmas? What should I expect?
Yeah, hey, Romain. Well, we're going to have to wait and see. We did get a preview from the White House press secretary, Caroline Leavitt, yesterday, who said to expect President Trump to tout his policies from the last year and to tease, in her words, new policies for the year ahead. Now, that could mean anything from immigration to foreign policy, but we do know that there's been one issue that this White House has been playing defense on and has been trying to change the narrative on, as we are really expecting the administration to try to set the agenda around the midterms, and that is, of course, the economy and the issue of affordability, as polling has repeatedly shown us that voters are growing discontent with President Trump's handling of the economy, the very issue that helped get him into the White House. This comes, of course, after a slew of Republican election losses last month. And since then, we've really seen the administration try to roll out policies such as farmer aid, investigation into food supply chains, and put other officials out there. Just today, we had the Treasury Secretary at a Trump savings account event and the Vice President, J.D. Vance, yesterday in Pennsylvania. But Romain, there is one issue that I'm very curious to see how President Trump addresses, and that is, of course, health care. That is the issue that is dominating the conversation today here in Washington, as it appears Congress is set to adjourn for the year without extending those expiring Affordable Care Act premiums.
Well, let's talk about that. I mean, the data shows where affordability is. That's not even a matter of debate. It's not even politics at this point, Tyler. But I am getting a little confused about what's been going on with these subsidies, particularly because it seemed to have been tied to that deal to get that budget breakthrough. So you have Mike Johnson basically saying, no, we're not going to do this. And now you have some Congress people pushing back on this, but not necessarily Democrats. It's certain Republicans who see this as an election year issue and say, hey, if we don't extend these subsidies, we're dead in the water come November.
Right, exactly. You framed it exactly correctly, Romain, to really highlight what has become heightened tensions between Republican leadership and moderate Republicans on the Hill. And in the last hour, we had some breaking news that there are now enough signatures on what is known as a discharge petition, which would force a vote on a clean 3-year extension of those Affordable Care Act premium subsidies. The thing is, due to House procedural rules, we're not expecting that vote to happen until the new year. And we're not really even expecting that vote to pass ultimately, because it would have to go into the Senate, as you well know, and they're working on their own separate plan. Again, lawmakers have also addressed that that vote isn't going to happen until the new year. I was talking to some health policy senior aides about how this would work, because these subsidies are set to expire at the end of the year, and this would be a retroactive plan to extend them. Maybe this could be some sort of rebate, but ultimately we know most of Republican leadership wants to get rid of the subsidies. They don't have the pay-fors to extend them, and instead, Romain, they have pushed this other proposal they say would lower costs over the long run, including implementing some regulations on pharmacy benefit managers, as one example.
We only have about a minute, Tyler, but I am curious just about what you think the potential balance in this speech is going to be, because obviously the affordability issue is something that President Trump himself seems to now be saying, look, don't bother me with that. But at the same time, probably one of his accomplishments, and I put that in quotation marks, but one of the promises that he made on the campaign trail was to crack down on immigration. And while he might have done that in a way that displeased some people, you can't argue with the results. So you've actually seen border crossings drop. Does he plan to lean into that with regards to his immigration policies?
That's a really good point, Romain, because if we look at last week's speech that President Trump made in Pennsylvania, our understanding was the expectation was it was going to be solely focused on the economy. But then we heard him speak about these other issues that particularly play well with his base, including immigration policy. We know, of course, immigration has had impacts on the labor market and the economy. I would probably expect President Trump to bring these up, but we do know, Romain, that his advisors do want him to stay focused on that economic message. He himself has said that Susie Wiles, his chief of staff, has told him that he's going to be hitting the campaign trail a lot leading up to the midterms with a focus on that economic agenda.
All right, Tyler Kendall outside the White House, where a little bit later today we are expected to hear from President Trump in a primetime address. Coverage of those remarks begins at 9 p.m. Washington time, a potential victory lap for the president as he closes out what's coming up on a full 11 months in office. Meanwhile, here on Open Interest, we check in on the markets now about an hour and a half into the session, and we've actually seen some significant deterioration, some huge selling pressure now coming across the tape in just the last 15 minutes. All of the major indices right now have flipped into the red, with the NASDAQ Composite and NASDAQ 100 the biggest decliners on the day, at least as far as the major indices, down more than 1%. The S&P down 0.7%, and the few bright spots that we had in transports, in industrials, and in some of those cyclical sectors, that's also giving back some of those gains as well. A lot of volatility right now in the yield space that also might be driving some of that pressure. The VIX elevated back above 17. Silver right now at a fresh record high. That doesn't pour open interest, but don't worry, I'm sticking around. You can catch me on the close, 3 p.m. Eastern Time.